You're welcome to another practical accounting training session. We are still on the accounting sec one. I told you that the accounting sec is all about how to refine business transaction and convert them into hardcore data that can be presented in the financial statements. We also highlighted various steps or stages by which we can achieve this purpose, and we have been able to look at the first stage, which is the execution of transaction, which I told you that most of the time you might not be part of it in practice, and what you might get is a bank statement. So the stage 2 is all about analyzing and summarizing the bank statement that you have been given by the business owner. You summarize it after analyzing it and classify it into various accounts. After then, we look at how to raise journal entries from the summarized transaction, and we also look at how to post the journal entry into the ledger. And today we are going to be looking at how to make adjusting entries. So we will need to learn how to make adjusting entries before we start preparing our financial statement. So today's video is going to be all about making adjusting entries. In adjusting entries is just like additional information. It's like additional information. Like when you're writing exams now, you just say what they give you your trial balance or whatever, you will see additional information there. But in real life aspects, you won't be giving any additional information. So you are going to be the one that is going to use your head to make adjustments. So in real life, nobody will say, "Oh, this is additional information." You are going to be the one to do them yourself. So in order for you to make your adjusting entries, you need to come to your trial balance, and you go through all the items in your chart of accounts, and you ask yourself, is there any adjustment to be made on this in this transaction or in this item? Like the first item here is the PPE as cost, that is your, let me say our fixed assets. And in the bank statement, we saw that the business owner bought a car, and this is the amount for the car that he bought. And since he bought a car is an asset, there's going to obviously be a depreciation. There's going to be depreciation for that particular asset. So that is why I wrote adjusting entry depreciation. So there will be a depreciation charge, and there will also be an accumulated depreciation. So we also continue long-term investment. Ask yourself, this account that I'm preparing, is there any adjustments to be made on long-term investments? If there is, you make an adjustment. If there is no need to make adjustment. The next one there is our inventories. Our inventories. You ask yourself, is there any need to make adjustment on inventories? Like this, for example, now this account that we are preparing is not a this product based business. It's a service based business, so there's no inventory, there's no stock. This one we just provide services, so they don't sell products. So there will be no adjustment for inventories. But if it is a business that that sells products, there might be an adjustment for inventories. Like let me say, you might do your closing inventory. For example, let me say you purchase goods worth 5,000 naira at the beginning of the year or during the year. So at the ending of the year now, the goods remaining in the shop was now, like let me say, 2,000 naira, right? That is the closing inventory. So there will be adjustments that will be made on those type of transaction, and that is very easy to do. The next one is your prepaid rent. Prepaid rent. You ask yourself, is there rent for these businesses? This business, if there is, you say okay. Let me look if there's adjustment for it. So you ask yourself, let me say for example now, there was a rent of 1.2 million naira per year. 1.2 million naira per year, and we started business maybe March, 1st of March, and we paid 1.2 million naira. We paid 1.2 million naira rent. That 1.2 million is not going to be, you're not supposed to record everything direct. There's going to be an adjustment because it's supposed to be 100,000 per month, 100,000 per month, since it's 1.2 million per year, and we just we paid from we paid on March, and it's going to end on December. That year is ending December. That is 10 months. So it will be 1 million naira, but 2 million naira won't just go like that because we not use for January and February. We're going to take it to the next year. So there's going to be adjustments for that. And another reason we are doing this adjustment is because most of these transactions didn't go through the bank. Most of them didn't go through the bank. For example, depreciation can't go through like the bank, so the bank can't even record it and put it in the bank statements for they're going to be the one to find out the they're going to be the one to find out that depreciation charge by yourself and add it to your accounts. The next one here is your receivable. Yeah, this one went through the bank. Trade receivable, this is a service based business or a product based business. But if it was a product based business, that somebody came to buy something in our side and the person did not pay us, that transaction won't even go through the bank because there was no money transferred to the bank. So you're going to make an adjustment on it if this is a product based business. So that is it about this one. Both the bank, the bank, there's no need to make adjustment on it. So, okay, let's come to the liability aspects. This VAT payable. If the business is like qualified to pay VAT, taxation is like a broad cost on its own. So it's not a scope, like it's not a part of this learning session. It's not a part of it. It's very broad on its own. But if the business is a business that pays VAT, or is qualified to pay VAT, you must record the VAT, and the VAT must go through the 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 um the bank statement. They're going to be the one to calculate the amount of VAT input and VAT output, you plus and minus the remaining amount. There will be your VAT payable. Taxation is like a very wide course on its own. So the amount of your VAT payable, you come and record it also. That one is compulsory as long as the business is qualified to pay VAT, which is this. So you remove your VAT from the sales, at you debit the sales income, and you credit your VAT payable. The next one is the income tax payable. So your income tax, you pay tax from your profits, that is your profit before tax. You remove like your 30% there. Remove your 30% there. But again, in recent, the accountant in the business, the accountant of the business is just supposed to like calculate the tax. The tax is like, let me say, and I'll just put an estimate there. It is the auditor that will come back and recalculate the real tax that is supposed to be paid to the tax authorities. You get, but although most businesses in Nigeria take the accountant as the auditor, like once they say that you're an accountant, they feel like, okay, this person said we fit do audit work. So they will just like say you are both an auditor and you're an accountant. So they will just say they will just employ you so that you'll be doing the two work just for one pay. So that is it about the income tax payable. Same thing goes for the withholding tax payable. Like, let me say, for example, that you have workers, and most of those workers are contract staff. So you will told some of their salary and pay to the tax authority. But if they are not contract staff, they are like your normal workers, you remove payee from them. So that is what you do. You just go through all the items one by one and ask, is this item qualified for an adjustment? Is this expense is qualified, I mean this item qualified for an adjustment? If it is, then you make an adjustment. So let's start let's start doing the adjustments for this business. So the first adjustment there is the depreciation. The first adjustment there is the depreciation. So in order for us to do depreciation, you have to also know the depreciation charge. In order for us to know the depreciation charge, we will need to know, okay, how much was the asset that was bought. How much was the asset that was bought? And the asset that was bought was, they said we bought car by saving our money. So we bought car and the amount was this. So let's go to the note 5. The note 5 is where our property, plant and equipment, that is our assets, fixed asset schedule, is is located. So there is no car here. Furniture and fit is not a car, equipment is not a car, machinery is not a car. So let's just insert a row and let's just put, okay, car. Let's just write this. You can put this as motor vehicle if you want, but let's just put car, just for the sake of this video and for the sake of learning. Okay, this is supposed to be 2024, but let us leave it like this. In your work you can change it. So there was no opening balance of car. There was no opening balance of car. It was just an addition of car that they bought during the year. So how much was the car? We put equal to, we go to our trial balance and we pick, because this was the amount of the car that we bought. This was the amount of car that we bought. Then we press enter. So this is it. There was no revaluation during the year. There was no disposal during the year. So we need to put our closing balance. Because we added the rule here, the formula that are in all these other assets like this furniture and fittings, the equipment and machinery, the formulas there won't be in this one because we inserted a new column. So let's add the formula back. So the closing balance, the formula should be sum of the C7, that is from the opening balance to the disposal. So let's do it. So equal to sum, sum of, that is from the opening balance, even though we don't have any opening balance, to the disposal. Then we'll press enter. So it has given us a sum and it automatically give us a total here. So the next place we go to now is our accumulated depreciation. There was no opening balance, or let me say a carried forward balance on car. So it was just an addition, the one that we bought during the year, which is this. So since there was no opening balance, there will be no opening accumulated depreciation. So we leave that one as that. Let's just put 0. So charge for the year is the depreciation amount for the year. Charge for the year is the depreciation amount for the year, and the depreciation amount for the year, that is the charge for the depreciation amount for the year. The depreciation amount for the year, let me say, in practice they use 20%, but although it depends on the company's policy on the asset, but in practice most people use 20%. So let's use the 20%. So if we come here, equal to this amount times 20%. We put 20, then we'll put percent there, 20%. Then we'll press enter. You see, it gave us this figure, but this figure is an absolute figure, we just calculated for the full 12 years. But if if let me say we bought the assets, let me say we bought the asset on March, for example. You bought the asset on March, so it will be maybe 2/12. I mean, no, it will be 10/12. 10 it will be 10/12 times 10/12. 10/12 to be 10/12. So if you bought an asset maybe March or so, you just put the date here. But let's remove it. We are taking it as if we bought the asset on January. So to give us this figure, there was no accumulated depreciation on any disposal. So the closing balance, which, remember, when we added this column here, all those formula are removed. So the closing balance now will be the sum of this opening balance till the disposal. So you will do equal to sum. The opening balance was 14, which is this. Then we hold our shift and we'll press down up to the disposal. Then we'll press enter. So we've gotten our closing balance. Then the carrying amount of the assets would be this. Remember, the formula here is also removed because we added a new column here. So the formula is no longer here. So but in order for us to get the carrying amount, we just do equals to this amount. We click it, equal to that amount minus this closing balance here. Then we'll press enter. So that is it. That is the carrying amount of our asset, and this is the depreciation charge for the year. This is the depreciation charge for the year. So we come to our journal entry side, we put equal to, then we go to our note 5. We click this amount and press enter. That is our depreciation charge, and we put equal to this amount here to get accumulated depreciation. So that is it. The next one here is our VAT. So you remember, taxation is like a full course on its own, and it's not in the scope of this training. But just for teaching and simplicity's sake, let's take our VAT as 7.5% of sales. But normally, to get your VAT is your VAT payable. Your VAT input and VAT output in order to get your VAT payable. And there are some items, some transactions that are this VAT deductible. So that is just outside the scope of this training. But for simplicity's sake, let's take it as 7.5%, which is the current VAT rate. 7.5% of our sales income, and our sales income is this is our sales income. Now press enter. Okay, so let me go back. 7.5, okay, no, equal to 7.5% of our sales income. So it's giving us this amount. So our VAT payable will be equal to this amount. Every debit entry must have a corresponding credit entry. You press enter. So the next one there is our income tax. So this income tax is easy also. The income tax is easy also. In order for us to get our income tax, it will be remember tax is outside the scope of this training, but for simplicity's sake, let us use it as, let's just do it. So equal to, if the statement of profit and loss, that is the profit after tax, the profit before tax, yeah, the profit before tax, if the profit before tax is greater than zero, if the profit before tax is greater than zero, give me 30%. That you put your comma, give me 30%, give me 30%, or else just give me zero. So in order to put the or else, you just put your comma, then you put zero. So come here, you put star. So this is the formula. If the profit before tax is greater than zero, give me 30%, or else, that is our star in the up, or else you give me zero. That is if the amount is zero or lower than zero, just give me zero as my income tax, because you can't be having zero or negative and you be paying tax. No, but they said if it is greater than zero, just give me 30% of it, or else you give me zero. So we press enter. So this is the amount that we are getting as our income tax payable. Then we put equal to this amount here, we press enter. And this amount might be, when we continue putting things in our template here and continue posting transactions, this amount would be changing by itself, because the profit might be increasing when you're posting some income, and it might be reducing when you're posting some expenses. So that is it about this adjusting entries. For the sake of this the assignments that I gave, this is just the three adjustments there. This is just the three adjustments there for the sake of the assignment. But you might be working for somebody. It's not just these three that you prepare. You will prepare so many adjusting entries. Like I said in the beginning of this video, if there's any adjustment in inventory, you make it. If there's any adjustment in prepaid rent, you make it. If there's any adjustment in loans, you make it. So that is it. But for this bank statement that I gave, that's just the adjustment. There. So after we've gotten our adjusting entries, the next thing we do is to start posting them into the trial balance. And remember, I said in our trial balance, yeah, we have the opening balance, we have the transaction within the year, we have the closing balance, and also have here that I said the journal entries. And the journal entries is where I said you'll be posting in our previous video, I said this journal entries where we'll post our adjusting entries, we will post our adjustments. Here. So let's start with the first adjustment. The first adjustment is depreciation. Depreciation charge is an expense. You debit the expenses and you credit accumulated depreciation. So let's go to depreciation charge in the expense aspects. So this is depreciation. You debit it equal to this amount. We press enter. Let's let me add one more row here, one more column here. Let me make it smaller so that we can be referring back to it, or maybe anybody that want to go through the work will know, yeah, this is where this amount is coming from. So let's put 1 here. Let's change this thing to a normal let's change it to a normal number without decimal. So we come to accounting, decimal place is 0 decimal place. Okay, so depreciation expenses, these are our first adjusting entries. That's how we make it as 1. You see, number 1, this is it, number 1, our depreciation. So we've done our depreciation charge and we've debited it. The next one is our accumulated depreciation. It's still under note 1. So we'll go to the accumulated depreciation. Accumulated depreciation will be under our liability. Accumulated depreciation. So we'll credit it equal to, we come here and we'll credit it, here. We press enter. It's still under note 1. You put it 1. Press enter. If I let me make here green, or put it in another color so that we will know. Okay. So we are done with the first adjusting entry. Then the second adjusting entry, which is the value added tax. We debit the sales income and we credit the VAT payable. So let's go and debit the sales income. Remember, all these adjustments will be under this journal entry aspect, because all these ones is made just for adjustments. So sales income, we debit sales income, so equal to this amount, Why we are debiting sales income is because the VAT is from our sales. So once we debit our sales, it means we are reducing the money from our sales, and once we credit our VAT, it means we are increasing our liability. So when you pay out money, you are increasing our liability to the tax authority. So we are just paying them their money there, and we are reducing the amount that we cost from our sales income. So this is note 2, the first side of note 2. So the corresponding aspect is the VAT payable. So we look for VAT payable. So this is VAT payable. We credit it equal to this. We press enter. We put it as our note 2. The next one is our income tax. So we debit, you see this amount is reducing. Before it was 5 something, but now it's reducing. So our income tax, we debit our tax expenses and credit our tax payable. So tax expenses should be under our expense aspect. So let's find our tax expenses. Yeah, these are our tax expenses. So we debit is that is equal to this. Let's put it as our note 3. Then we credit it. We credit the tax payable. And tax payable should be under our liability. So income tax payable, yeah, this is it. Income tax payable, then we credit it equal to this amount. Press enter. So that is it about the adjustment for this particular bank statement. We've fished out our adjusting entries, fished out our adjusting entries, and we've recorded them in the journal entry. So the next thing for us now to do is to start preparing our financial statement, which comprises of our statement of profit and loss, statement of changes in equity, the statement of financial position, and statement of changes in cash flow. So that is it on the adjustment. So in the next video we will do those statement of financial positions and the rest. So that is it for this particular video. Bye for now.